Tech led all sectors last month, gaining just shy of 13% despite November's outperformance. Our next guest still sees investor opportunity in a wide variety of stocks. Joining us right now is Dan Flax, senior research analyst in Neuberger Berman. So what do you do? The Magnificent Seven, magnificent. How long are they magnificent for? What's the strategy at this point?
Good morning, Andrew. I continue to like select names across the technology space. These companies are all facing cyclical headwinds, but what we're seeing is that they're able to innovate, adapt, change, and grow. And I think as the market increasingly looks ahead to 24 and even 25, you're going to see better growth. So, for example, Amazon, the retail business is seeing consumer pressure, but they're reinventing it. More one-day delivery. Amazon Web Services remains well-positioned for the next generation of workloads in areas like artificial intelligence. Microsoft, too, is innovating and capitalizing on AI. And so if you step back, sure, interest rates are still at higher levels than they were a few years ago. The economy is slowing, but these companies are adapting, and I think you're going to see better and better growth.
Do you care about what happens with the Fed? And the reason I ask is because one of the reasons they've actually gone on a little bit of a tear here is the function of this new conventional wisdom that the Fed is somehow going to lower interest rates next year. By the way, even though Jamie Dimon, I think, thinks they may still raise.
I'm more focused on the innovation and the growth, because if we look across a cycle and if we look back in history, and I think if we look forward, it's going to be about situations or companies that can create and expand into new markets. You look at Google as one example. They are reinventing search with generative AI. Apple, as much as they face pressure in consumer and China, you see a continued broadening of their growth drivers. Services remains healthy. And so were interest rates to be a little bit higher or a little bit lower, I would still focus more on the innovation and growth. I think that will matter most to these companies' prospects and ultimately their share prices.
Of the tech companies out there, are there ones you just don't want to touch right now?
There are a lot of names that we're looking at that are transitioning. And so, for example, if I look at a company like an HP or an IBM, good management teams, businesses where they're making a lot of investments, we're watching to see how names like that continue to pivot towards faster growth areas. There are other companies that we like. For example, Qualcomm, a leader in mobile and low power solutions, where we think they'll have better growth over the next year. Given what's going on there. So we're looking across a wide variety of names, but we're trying to remain selective.
Of all of the companies, if you could only own one, actually, I'm going to make it more complicated, Dan. You can only own one, and you have to own it for 5 years. You cannot sell it for 5 years from today.
It's Alphabet, Andrew. We like Google. I think the search business is durable. I think it's continuing to reinvent itself. You have accelerating growth in YouTube, and I think that business will double over the coming years. And you have an underappreciated. You don't worry about AI taking the search business, somebody else emerging. I always worry about competition. The competition is fierce, but what we're seeing with Google is that they're infusing more generative AI capabilities. The search experience is changing, and it's creating value for advertisers on one side and users on the other. And I think that will create a larger market. And of that market, I think Google will have an attractive share, which will drive strong free cash flow growth. And that is why I like it.